Good morning, everybody. We're going to give it just a couple minutes here, let everybody get logged in. Good morning, everybody. It's 8:30. We're going to give it just a few minutes. I see people are still logging in here, so we'll get started in just a couple minutes. All right, we're going to give it just a few more minutes. I see two people are logging in right now, and there's a couple people in the waiting room that are jumping on as well. Hope everybody's having a good morning. I hope everybody's got their coffee, their pens and pencils ready. All right, we're going to go ahead and get started here. So hope everybody's having a great day. I want to talk about some things that are in the news headlines, and they're going to be in the news headlines more and more here over the next few weeks in particular. And that's the debt ceiling, or some people call it the debt limit. So this is purely an educational seminar. Okay, so we're going to be talking about the implications of a debt ceiling, what it is, different factors that will also get considered with it. This is a Q&A, so this is a live webinar that we're doing. I have an associate that just logged in here as well. He'll be looking through different questions that you have. So at the bottom of the screen, you'll see a Q&A button. You can click that Q&A button and type in any questions that you have, and we will address those at the end as we go through. Joey Bunton, who's another advisor here at the office, can actually answer some of those questions as well while we're going through the webinar, if we have an abundance of those and don't think we'll have enough time to get through. So like I said, ask any questions that you have. We'll dive through them in detail and be able to rock and roll here. So with that being said, let's get started. So the debt ceiling is, or actually, excuse me, before I even dive into that, today's agenda, we're going to talk about what the debt ceiling is. We're going to talk about what's going on. So how did we get here? What key takeaways do we have to have looking ahead? There's a big bullet point that you see listed up here, which is number 3, and that's a shutdown versus a default. There's two completely different things. And then I'm going to leave you with some things to consider going forward. So the first piece is just, what is the debt ceiling or debt limit? This is something that some of you may have heard of in the past, and others have not heard about it other than when it's brought up in the news every few years. So you can see the definition. This is directly off of the Treasury's website. So the debt limit is the total amount of money that the United States government is authorized to borrow. So each year, the federal government has a budget, and those are basically the constraints or limits stating how they can spend their money, where it can be allocated to, And you can see some of the services that this includes, right? Social Security, Medicare, military salaries, governmental employees, our national debt, tax refunds, and then also there's treasury payments and debt to other nations, right? In simple terms, right? So a lot of clients read that and they say, what the heck does that mean? So in simple terms, the U.S. has been spending a greater amount of money throughout this year and the past few years than originally was budgeted or created in the budget. And what they're doing is they're asking Congress for permission to increase that spending limit and spend more. So that's the piece that we're looking at this point is we're seeing the U.S. spend more money than we budgeted. And now they're looking for an increase so they can continue the spending trend or continue the programs that they currently have in place. As we look at the debt ceiling, we've been here before, right? So, what's going on right now is we have an estimated spend of approximately 31 trillion in a deficit. We've gone through that in the course, or we've gone through the yearly budget that we have in the course of about 5 months. And there's a lot of pieces that go into that. Just know that in the past, we've had what they call clean raises on the debt ceiling. So the debt ceiling has been increased multiple times, even under the Trump administration, the previous president. We increased the debt ceiling 3 times during his tenure, and those were what were called clean increases, meaning no one argued on either political side during that time. The reason that you're hearing more about it right now is because the Treasury Secretary came out and said that the Federal Reserve is at a point where they're going to run a deficit in some capacity starting on June 1st. So meaning that the Treasury needs to have an increase of assets, right, infused, or a debt ceiling raised by June 1st. That's what they call the X date. And obviously, the closer we get to that date, the more nerves and jitters start to come. Politicians right now are arguing regarding if they should spend more or if they should start cutting some of the spending that they have going forward. So there's a budget, and that's part of the conversation. If you listen to the news or you listen to the different pieces that are out there, the 2 political parties at this point, I mean, it's just an absolute, in my personal opinion, is an embarrassment on both sides of the fence to sit here and listen to where we've gotten to and how they didn't have any negotiations until there was a date or a line drawn in the sand. And now we're actually starting to see that. So a lot of political gamesmanship up to this point. The market hasn't reacted that negatively to this point because most people, right, are sane, rational thinkers like you and I. And we look at it and we say, okay, anybody in their right mind would not want to default. We've never defaulted in the history of the United States. Both parties have come out and stated that a default is off the table. That's their terms, not mine. So neither party wants to default, but here we are, 2 weeks away from a deadline saying, what the heck's going on? Right. And that's the frustrating part for you and I is we have no control over that. And there's individuals that are negotiating all of those terms. So this is when they put an X date or a line in the sand, it gives both political parties the ability to come together and say, okay, we need to come to a resolution versus just kicking the can down the road and continuing to put it off. So it's very much so a political tool right now that's being used. And that's why it's getting so much publicity. The closer we get to that deemed deadline, you're going to see more anxiety built up. So the closer we get, that's where we'll start to see more of the volatility creep in. Once again, you're still holding really, really good companies. Volatility is a normal aspect of the market. But like anything else, the market doesn't like the unknown. And do I think they're going to default? Absolutely not. I do not think that. But the closer we get, there's always that possibility. And that's where the anxiety comes from. The key piece that I want to touch on is what's called a shutdown versus a default. Okay, so I want you guys to think back. So the government has shut down over 20 times. So that's the key phrase. And you can see on the left side of the screen, it shows shutdown. On the right, it shows default. Okay, the government has shut down over 20 times in its nation's history. 4 times have been for over a 1-day period, and that's where you hear about them most. Most recently, we had a governmental shutdown in 2018, and many of you can probably remember that time. We had, federal parks were closed. We had governmental employees that were furloughed or laid off, and that was a 35-day layoff. So it was over a month of people that were without jobs. Businesses that had governmental contracts were not getting paid. And it was the same thing. And that was more so over the border crisis and the wall that they wanted to build at the time. So U.S. agencies get closed down during a governmental shutdown if they are not deemed what's called essential. So essential employees would be like the IRS or public service, meaning police officers, firefighters, etc. So they would deem those essential. Anybody who was a non-essential employee, right, was furloughed without pay. But what we've learned the script of what's happened in the past. What they do is when they pass the new bill or the new budget or they reopen the government, they're building in back pay for all of the individuals that were furloughed. And in most cases, they actually give them a little bit of an interest or raise at the same time. So what we see is it ends up being a 35-day, in this example, it was a 35-day period where employees were furloughed. And I don't like to see anybody laid off, but employees were furloughed, but they did receive back pay. And there were different programs that were put into place to make sure that if they did default on a mortgage or something like that, they would be covered due to a circumstance that was outside of their control, with the government obviously being shut down during that time. That is not as scary. We could see a governmental shutdown, absolutely, right? Do not be scared of that. We've had those in the past. We've seen the script. I'm going to show you some details on statistics with the market and shutdowns here in just a bit. But realistically, I'm not as scared of a shutdown. I'm more so, when you talk about a fear factor, the default is the term that needs to be talked about more. Okay. A default is something we've never done in our nation's history, nor do I think we're going to do it right now. So it's never happened in the history of the United States. The impact would be negatively significant. So it would be a catastrophic type event, and it would be the first time ever. No one truly knows the direct impact because it's never happened. And the fact that we're talking about it right now when both parties don't want it tells you how much window dressing is occurring in this political banter back and forth. But ultimately, just be aware, right? There would be a negative impact if the U.S. did default, and we'll talk about some of those. And it would not just be felt here inside the United States. It would be held, or it would be felt around the world, right? The U.S. dollar is the number one currency used in circulation in the world, not just in the United States. And that's backed by the stability of the United States government. So it would impact the entire world and the entire world banking system, the entire world's currency, how we're viewed. It would be a significant impact that would be felt. So let's look further into detail when we talk about the shutdown. So this was interesting when I started doing research on this. Right, and you can see on the screen, right, the government's most recent shutdown for the 35-day period, right, that was the longest pause we had in our nation's history, and that started December of 2018. So, over that time period, the S&P was actually up 10%. Now, most people read that and they say, well, what? The market was up 10%. Well, it was up 10% during that time period because the market knew a resolution had to come, and most of the sell-off and volatility occurred prior to the shutdown occurring. So as we look at that, with the shutdown that occurred, a lot of volatility will run up or be impacting or having an impact prior to the actual event occurring. Once the shutdown occurred, the markets knew that, we had to come to a resolution. We can't be shut down forever. And we started to see positive returns start to come from that because you had a lot of people start to purchase up equities, purchase up companies, knowing that a resolution would come. So since the mid-70s, the government shut down 20 times, and the S&P was positive about half of those shutdowns. So there's no true indication or market indication that states one way or another what would be happening with the market during a shutdown. As I said before, do not fear a shutdown. This is something that's happened before. We've seen the playbooks that have occurred with this, and it's not something that you should have a fear going into. As we talked about before, the default is much more catastrophic. So when you hear the word default, what it simply means is the U.S. can no longer pay its debts. And it starts a domino impact of multiple issues. So number one, you'd see mass layoffs that would occur right away. So especially governmental agencies. Well, if you think about it, the number one employer in the world, right, or in the United States in particular, is the U.S. government. Right, that's our number one employer in the United States, and I believe it's one of the top, if not the top, in the world. So as we look through that, the governmental agencies would all be shut down. As they're shut down, people are laid off. But it's all of the governmental contracts that are out there for those companies that would also be laid off, shut down, and no longer being paid. So if you're a company or a corporation, and you think of a lot of the large corporations in the United States, if they're building something for the government, being paid by the government, think of the healthcare industry, et cetera, they're no longer getting paid if the U.S. can't pay their bills, right, during that time period. So there would be mass layoffs that would occur. The U.S. debt would no longer be considered or deemed as safe as it currently is. And that's the biggest piece that I can tell you right there, right? That simply means that the interest that we pay right now, the U.S. backs their, debt and so forth, and they sell treasuries. Well, because it's so stable, we can pay a reasonable amount of interest or a lower amount of interest on those treasuries because they're deemed safe, and other countries will actually purchase those to help satisfy their growth need with their underlying economies. So as we do that, if we default, meaning we can't pay back the treasuries or the interest on those treasuries, the issue we run into is now we need to start paying more interest if we want people to buy them going forward. So think about it. If you can get a 4% in a treasury, but all of a sudden that's not safe, well, if I want you to buy that treasury, I need to pay you 8, 9, 10% to reward you for taking the risk of purchasing that treasury. So what we see is if they do that, that means the interest that we're paying towards our nation's debt, which is 31 trillion, would increase exponentially and just be absolutely detrimental to the U.S. economy, because the issue we'd run into is now we're paying substantially more in interest, and it just balloons our national debt going forward. So it'd be similar to you having credit cards. You miss a payment, and you were at a 10% credit card interest before, and all of a sudden they ratchet that up to 25% interest as a penalty, right? Because you're deemed a risk to them for not making your payment. I do not see that. I'm going to say that again. I do not see that happening. I do not see the United States defaulting on their debt. I'm just showing you the different impacts that would occur and things that you'd hear about on the news. So third bullet point listed on here is countries would be less willing to work with the U.S. going forward with their debt, meaning that if we're trying to raise capital through the sale of treasuries, through supplying stability to other nations economically, they're going to be less willing to work with us because there's more risk that's now attached to that, right? If another country put the majority of their reserves in the U.S. debt to get some interest rate, and all of a sudden they're not getting paid, it's just gone, right? That's a huge risk that would be out there. The global financial system is based on the U.S. dollar. Right? The US dollar would be in a detrimental point if it's no longer stable, and we would have a negative impact on that, which would really ruffle feathers on the global market, and we would see a negative impact that started. Treasuries would not be paid during the default time period. That would obviously cause ripples with anybody who holds those or trade partners that out there. Basically, in summary, I think I probably should just put this on the page. There is no good outcome from a default, right? Nothing good happens from a governmental default. Both parties know that. The citizens of the United States know that. I do not think it will happen, but no good outcome comes from that. So just be aware. Just be aware of that. So when we talk about what are some resolutions that are out there as we look through this? right? So there's 3 points you hear about in the news all the time. And realistically, as we look at these, two of the three, in my opinion, are not a real resolution. The third one, which is bolded on the screen here, is, right? So the first one that you hear about is the Treasury could mint $1 trillion coin. And honestly, I think of when I hear that, I think of Monopoly, right? You just, oh, here, I'm printing some fake money, or here's a shiny coin, and this is $1 trillion. I mean, $1 trillion is just an enormous amount of money. And the fact that we're talking about just minting $1 trillion coin, the Treasury Secretary came out, multiple members of the Fed came out and said that is not an answer. That is basically putting a Band-Aid on a solution, or just trying to avoid the debt ceiling conversation altogether. The one that's gained more traction, especially through the negotiations, is utilizing the 14th Amendment. And the 14th Amendment basically states that the U.S. will never be questioned on its debt. And that's a very, very open-ended question, very, very open-ended response to that. The issue with doing that is we're under the gun where we need to get to a resolution. And even if President Biden were to enact the 14th Amendment, it would be the fourth time, or the first time it would ever be used. And there would be such a lengthy court battle that would follow it, and more money that would be cost. And, really, it doesn't solve any of the logistical issues, right? The debt ceiling is put in place to honestly protect the United States from overspending. It's a safeguard. Do we really want to take the training wheels off, per se, right? And say, hey, there's no ceiling that we ever have to have a conversation around going forward. And this is for both parties, right? I'm staying completely politically neutral as we go through here, because both parties need that governor, per se, to control the spending. So the 14th Amendment, I do not see that being utilized. If it is utilized, it will be heavily scrutinized. It would still be it would be a black eye on the United States, because it means we couldn't come to a resolution and we had to take extreme measures. So I don't see that being the resolution that we come to as a nation. The third piece, which honestly, when you think about it, makes a ton of sense, is just, hey, we come to a resolution and we agree to terms to raise the debt ceiling. So the short answer is we need to increase the debt ceiling because the United States government has to operate, right? We need to function. Think about it. If hospitals aren't getting paid, Medicare bills, how are they going to provide care to people? If individuals aren't getting paid their Social Security on a monthly basis, that's their livelihood for the majority of America. You look at those different pieces. That's something where the government has to come to terms, and they will. But they're bringing it right down to the deadline, just like they always do. So I highlight that third option, just because I do believe that they will come to terms and raise the debt ceiling. We're just obviously taking it right down to the deadline, which we're known for here as of late. So the outlook is the U.S. has to increase the debt ceiling in order to continue to function as a nation. So it's not an if, it's a when. Obviously, a shutdown, as we talked about, versus a default are two completely different things. We could see a governmental shutdown and not default, right? Back in 2011 was the closest time we've ever come to a governmental default. At that time, President Obama was in office, and he signed a bill a few hours before the deadline that allowed the government to increase their debt ceiling. Standard & Poor's and Moody actually downgraded the U.S. debt rating at that time, which was a pretty significant impact. So I don't think that they want to take it to that measure. I don't think we're going to get to that point. But just be aware, we've been closer than where we are right now in the past, and we're very resilient. We're the best nation in the world, right? We really are. So the Treasury is stating that actions need to be taken prior to June 1st. They call it the X date. There's no true date out there because there's so much revenue coming in and going out from the Treasury on a weekly basis, a week by week basis. So for example, last Friday, they had over $140 billion in the Treasury. Right now, they're at $87 billion in the Treasury, and that will continue to fluctuate. Right? Meaning they have more revenue that will hit this week from treasuries. They have more revenue that will hit from different taxation and revenue coming in that way. So it's a floating measure. So June 1st is the date that they're estimating. It could be after June 1st. It could be on June 1st. There's no true accurate measure that way, but that's the date that they're drawing the line in the sand. There's a lot of political showboating, as I said before. All right, so both parties are trying to gain an upper hand during this. And if you look at both sides, the Democrats are saying this is the budget we put forth. We're going to continue with this budget. We don't want to cut anything. The Republicans are saying, hey, this is the only way I can get you to the negotiating table to actually get some headway. And we want to gain the upper hand and cut some of the governmental spending that's occurring in different pieces. So, they're right now, they have decreased the number of negotiators, which is very positive. They had way too many way too many individuals with a loud voice in a room for a 1-week period trying to get to a resolution. And now they're down to realistically about 4 individuals that are negotiating this out, and they're hatching through some of the more intricate details. And that's where we can start to actually see some progress. So I'm excited from that regards to start to hear that we're getting less people in the meeting rooms and actually starting to see some rubber meet the road. So key takeaways, just remember, right, if you're taking notes and you're talking to individuals and they bring this up, or if you're watching the news, huge difference between a shutdown and a default. The United States has shut down, as you saw before, over 20 times in the last roughly 35 years. 4 of those times have lasted for more than 1 day. Of those 20 times, right, the market has been positive 50% of the time, down 50% of the time. The most recent round was 2018. And the market was actually up about 10%, right? So shutdowns happen. Defaults have never happened. And that's the biggest difference, is a default is a huge catalyst for the negative. We do not want to see that. If you hear between the two, we could see a shutdown. I do not foresee us seeing a default on our nation's debt. Neither political party wants a default. Just remember that. So you have 2 parties in the room, 2 people in the room that want the same thing and can't come to an agreement, right? It's just, I'm shaking my head just like I'm sure you are. So neither party wants the default, which leads me to believe that there will be some form of resolution. Both sides are heavily negotiating at this time, and you're starting to hear more optimistic tones from those negotiations. So that's a positive, right? Before, it was very much so gloom and doom. I always chuckle because you'd watch one news station and they say, oh, the talks went great. You'd watch the other news station, they say the talks went terrible. Right now, you're actually starting to hear some more upbeat information from both sides of the fence, which is a good thing. And the last key takeaway before we dive into questions here, okay, the last key takeaway, I cannot reinforce this enough, is do not spend all day watching the news or stressing over things you can't control. Okay, you and I have no control over what's occurring in that negotiation room. And I have clients that do this. They spend a lot of time watching the news, and it will get your blood boiling. Depending on what side of the fence you're on, it will get your blood boiling, and that's not healthy. And I don't want you to be at a stressed level, especially over things that you have no control over when it comes to that. So don't spend all day watching the news getting stressed out. All right, with that being said, I'm going to go through and start addressing some of these questions here that we have on the screen. Joey, did we have anybody that went through, or any questions you want me to cover here based on what you've read?
I just clicked the answer live button for a question that says, what is the difference in causes for a shutdown versus a default? So what's the difference in the cause of a shutdown versus the cause of a default?
So the biggest difference is a default is we're against the deadline for governmental spending. So back in 2018, we shut down the government, but we weren't at a point where we were going to run a deficit, meaning we had enough money in the treasury to continue to function, pay our bills, and maintain, all of our debt service that was in place. So we weren't up against the gun with that. But they did increase the debt ceiling during that time. So as I talked about, that was during President Trump's administration. They increased the debt ceiling 3 times. And it was what's called a clean increase. Both parties voted to increase the debt ceiling 3 different times during that time period. So the difference between a shutdown and a default, just to get more in the weeds for right now, Joey, with what we're seeing, if the if we did not come to a resolution right now, okay, if we did not come to a resolution with raising the debt ceiling, it does not mean that we are going to default on our debt. That's the key difference right there. And you will not hear the news say that. You will not hear media say it. It drives me crazy. There is a huge difference between a shutdown and the debt. What they will do is they will deem what is essential and what is not. And they will deem, based on what we've seen in history, in 2011, if you look at the playbook, they deemed treasuries and other pieces as essential and continue to make the debt service payments on those, but shut the government down. So what they would mean is they would lay off different workers, furlough those individuals until they raise the debt ceiling. But it does not mean, if they don't come to a resolution by June 1st, it does not mean they're going to default on their debt. They'll just continue to choose what they pay out and why they pay it out based on what is essential and what's not. Really good question.
We have one more question. Can the yuan, Chinese currency, become the world's currency instead of the dollar in case of a default?
Could it? It could. It could, but it wouldn't happen overnight. If you look at the U.S. currency, right, in the past, it was used in over 86% of world transactions. So it was by far the largest currency used out there, the largest standard that's used out there. And this is a whole nother, we could do a whole webinar on currencies. Basically, what's happened over the years as we, rather than go to war or armed conflict with different nations, the United States will impact or put out sanctions against countries that don't necessarily agree with everything that we need to have happen. And that's a form of economic warfare. Well, that can only happen for so long before countries look at that and say, you know what, I want to find an alternative around that. And I don't want to use the US dollar, because if you sanction me, you're just going to take these proceeds, or you're going to charge me a tax or do different things with the currency to benefit the United States and penalize whatever country is not behaving the way that they should be. So in terms of the yuan coming in and replacing the US over this, no, I don't see that being the issue, as the US currency is by far the most safe standard that's used. Where you could see it is you would see a push for people to look at other alternatives for safety. China's probably not going to be the run for safety there, just because they manipulate their currency so much that I don't see a big flow that will occur. But it would allow other individuals to come in, other nations to come in and create trade agreements utilizing their currencies directly and not the United States, because it's not that stability piece that it once was. So that was a really long answer to a short question. I don't see the yuan replacing the US dollar because of this, but it would trigger other events of negotiating between countries and trade partners to possibly use that currency versus the US currency as the standard for their trade agreements. And I like, same thing, I do not foresee the US defaulting on their debt. So I think a lot of this conversation is for naught, but I did want to have this conversation with all of you.
Going once, going twice. Doesn't look like we have any additional questions at the moment.
Perfect. So, I did see one question that we had earlier in the presentation talking about, it was bringing more of the Ukraine war and some of the spending that we've done there onto that. So I'll touch on, I'm not going to go into detail on it, or heavily into detail on it, but basically with the spending we've had with the Ukraine war, a lot of that is through our defense budget. So that's built into the budget in many ways. I don't know, to be completely transparent, what percent of our defense budget has been utilized with the funding of Ukraine and the war there or not. And that's something we could look further into. But a lot of it is utilized in the defense part of the budget that we've accounted for, which was exceptionally higher last year and this year than years past to continue to ramp up our military. So I don't know specifically what part of our budget was spent on that to address that question. I don't want to ignore it. So with that being said, if there's any other questions, please feel free to reach out to us here at the Tranel Financial Group, right? Just remember, this is something you can't control. You need to stay long-term with your focus and not get caught in the day-to-day and not get stressed out by those. right? You're in really good, solid companies. And that's why a shutdown, as I said before, doesn't scare me as much. You're not going to stop buying your food. You're not going to stop buying toilet paper, Kleenexes, all of those different pieces that we talk about all the time. They're not impacted negatively during those governmental shutdowns. So the shutdown should not scare you if you see that. We very well could see a governmental shutdown. I just do not see us having a governmental default based on history and based on both parties coming to agreements that they don't want to see that as well. So that's the positive news I'll leave you with. If you have any questions, as I said before, please feel free to reach out, and I really appreciate you taking the time to tune in this morning. Have a great day.